If you're collecting Social Security benefits or planning to in the near future, what I'm about to tell you could directly impact your monthly payments starting in 2026. In the next few minutes, I'll reveal the exact percentage increase you can expect from the upcoming cost of living adjustment, explain a new tax deduction that could save seniors thousands of dollars, and warn you about major changes to food stamps and Medicaid that many people don't know about yet. Plus, I'll tell you about a critical deadline that could affect how you receive your Social Security payments. Welcome to Financial Area, where we break down complex financial changes so you can make informed decisions about your future. If this information helps you, please hit that like button and subscribe for more updates on Social Security, Medicare, and other benefit programs. Let's start with the news everyone's been waiting for: the 2026 Cost of Living Adjustment. The Social Security Administration is expected to announce a COLA increase for 2026, and current projections put this increase between 2.4% and 2.7%. Now, I know what you're thinking. That sounds pretty good, right? Well, let me break down what this actually means for your monthly check. For the average Social Security recipient, this percentage increase translates to approximately $30 more per month. Yes, you heard that right. Just $30. If you're receiving the average monthly benefit of around $1,900, a 2.5% increase would bring your monthly payment to roughly $1,948. That's an annual increase of about $360, which might help with some expenses, but certainly isn't keeping pace with the rising costs most seniors are experiencing. The reason this increase seems so modest is directly tied to how inflation has been trending. The COLA is calculated based on the Consumer Price Index for urban wage earners and clerical workers. And while inflation has cooled from its peak in 2022, it's still affecting everyday expenses like groceries, utilities, and healthcare, the things that matter most to retirees. The Social Security Administration typically announces the official COLA in October, so this 2.4% to 2.7% range is based on current economic projections. Experts are fairly confident in these numbers because they're calculated using specific inflation data from the third quarter of each year. What's concerning many financial advisors is that this modest increase may not adequately address the real-world cost increases that beneficiaries are facing. Different types of Social Security recipients will see varying impacts from this adjustment. Those receiving disability benefits, survivor benefits, or supplemental security income will all see proportional increases. But again, we're talking about relatively small dollar amounts that may not make a significant difference in purchasing power. Now, here's some potentially good news that could help offset the modest COLA increase. There's a new tax provision that allows seniors aged 65 and older to deduct $6,000 from their taxable income starting in 2025. This deduction is separate from the standard deduction, which means it's additional tax savings. For a senior in the 22% tax bracket, this $6,000 deduction could save them about $1,320 per year in federal taxes. However, there are important limitations you need to know about. First, this deduction is temporary. It's not a permanent change to the tax code. Second, it phases out for high-income earners, so if you're a married couple filing jointly with income over certain thresholds, you might not qualify for the full deduction or any deduction at all. The income caps aren't finalized yet, but based on similar provisions in the past, we can expect the phase-out to begin around $100,000 for single filers and $200,000 for married couples filing jointly. This means the deduction is primarily designed to help middle-income seniors, not high earners. Unfortunately, not all the news is positive. There are significant changes coming to other benefit programs that many seniors rely on. The Supplemental Nutrition Assistance Program, commonly known as food stamps or SNAP, is undergoing major modifications that will reduce benefits for many recipients. The most significant change is that SNAP benefits will now be calculated using the 2021 Thrifty Food Plan as a baseline, rather than more recent data. This seemingly technical change actually results in lower benefit amounts because the 2021 plan doesn't fully account for current food price increases. Many families could see their monthly food assistance reduced by $50 to $100 per month. Additionally, work requirements for SNAP benefits are being expanded. Able-bodied adults between 18 and 49 without dependents must now work at least 20 hours per week, or participate in a training program to receive benefits. This requirement was previously waived in many areas due to high unemployment, but those waivers are ending. The program is also limiting several deductions that previously helped people qualify for higher benefit amounts. For example, utility allowances, which helped offset the cost of heating and cooling, are being restricted. Medical expense deductions for elderly and disabled recipients are also being tightened. Medicaid is facing similar restrictions that could affect millions of seniors. The federal government is shifting more costs to individual states, which means states will have less federal support to provide comprehensive Medicaid coverage. This could result in reduced services, longer waiting lists, or stricter eligibility requirements, depending on your state. Perhaps most significantly, work requirements for Medicaid are being extended. Previously, these requirements typically applied to adults up to age 49. But now they're being expanded to include individuals up to 64.5 years old. This means that if you're in your early 60s and rely on Medicaid, you may need to work or participate in community service to maintain your coverage. States will have some flexibility in how they implement these requirements, but the overall trend is toward more restrictive eligibility criteria. This is particularly concerning for seniors who may have health conditions that make it difficult to work but don't qualify for disability benefits. Now, here's something that affects every single Social Security recipient, and it's coming sooner than you might think. As of September 30th, 2025, the Social Security Administration will completely stop mailing paper checks to beneficiaries. This isn't a gradual phase-out, it's a hard deadline. If you're currently receiving paper checks, you must switch to electronic payments before this date. The two main options are direct deposit to your bank account or loading benefits onto a Direct Express debit card. The Social Security Administration has stated that there will be very limited exemptions to this rule, and they'll only be granted in extreme circumstances. This change is part of a broader government initiative to reduce costs and improve payment security. Paper checks can be lost, stolen, or delayed in the mail, while electronic payments are more secure and arrive on time every month. However, for seniors who aren't comfortable with electronic banking or don't have bank accounts, this transition may be challenging. If you haven't already set up direct deposit, you can do so by calling Social Security at 1-800-772-1213, visiting your local Social Security office, or logging into your My Social Security account online. The process is straightforward, but don't wait until the last minute. Government offices can get overwhelmed as deadlines approach. For those who don't have traditional bank accounts, the Direct Express card is a viable alternative. It's a debit card that receives your Social Security payments electronically, and you can use it to withdraw cash from ATMs or make purchases. There are no monthly fees for basic usage, though some services like ATM withdrawals may have fees depending on where you use the card. So how should you prepare for all these changes? First, if you're receiving paper checks, make the switch to electronic payments now. Don't wait until September 2025. Handle this immediately to avoid any potential disruptions to your benefits. Second, if you're 65 or older, talk to your tax preparer about the new $6,000 deduction and whether you qualify. This could provide meaningful tax savings, especially if you're in a higher tax bracket. Third, if you rely on SNAP benefits or Medicaid, contact your local social services office to understand how these changes might affect your specific situation. Each state will implement these changes differently, so you need state-specific information. Finally, with the modest COLA increase expected for 2026, now is a good time to review your budget and look for ways to stretch your Social Security benefits further. Consider reviewing your Medicare plan durable. Nung open enrollment to ensure you're not overpaying for coverage, and look into state and local programs that might help with utility costs, property taxes, or other expenses. The landscape of government benefits is changing rapidly, and staying informed is crucial for protecting your financial security. These changes affect millions of Americans, and understanding them now gives you time to adapt and make necessary adjustments before they take effect. Make sure you're subscribed to Financial Area for ongoing updates about Social Security, Medicare, and other benefit programs. The rules change frequently, and will keep you informed about everything you need to know to maximize your benefits and protect your financial future. Hit that like button if this information was helpful, and I'll see you in the next video.